Welcome to The Explainer. Today, we're unpacking a strategy that is honestly wildly popular but surprisingly misunderstood, even by seasoned investors. I'm talking about covered calls. If you've ever stared at your portfolio and thought, man, how can I squeeze just a little more active income out of these assets I'm just sitting on? Well, you are in exactly the right place. We're going to demystify this option strategy today. And even though we're dealing with high-level equity mechanics, we're going to break it down using a fun, totally everyday mental model so you can actually visualize exactly how the cash flows.
Okay, let's dive into this. I want you to imagine, just for a second, being able to generate extra cash from something that is just sitting on a shelf in your house doing absolutely nothing. Think about a classic, super highly sought after video game that you own outright, but you aren't currently playing it. What if someone walked up to you and paid you cold, hard cash today, literally just for the possibility of buying it from you later? You do absolutely nothing, you lose nothing today, but you get paid. That is the exact essence of what we're looking at with this strategy.
So, part one, the video game analogy.
All right, to really grasp the mechanics here, let's frame you as a savvy collector. Picture this. You own an epic, incredibly rare video game. It's highly valuable, sure, but right now, it's basically stuffed in the bottom of your backpack, collecting dust. Maybe you haven't even looked at it in years. In financial terms, we'd call this a completely idle asset. Like, it looks fantastic on paper. It definitely adds to your net worth, but it's not exactly putting any daily cash in your pocket, right? It's really just sitting there, waiting for the market to decide what it's worth. Now imagine a friend comes along. They desperately want this game, but maybe they don't have the full cash to buy it at today's market value. Or, maybe they're just hedging their own bets. So they offer you a pretty interesting deal. They hand you a crisp $5 bill right now, completely non-refundable, just for your promise that they have the right to buy the game from you next month for $50. That $5? Well, in the financial world, that's what we call your premium. It's upfront cash in your pocket today just for making the promise. And the best part? You keep it no matter how the story ends. Moving on to part two, what does covered mean? And this brilliantly illustrates the line between reckless speculation and a secured strategy. On the left here, we have a naked call, which, as you probably know, is like taking that $5 and promising to sell a game you don't even own yet. I mean, if the market spikes, you're scrambling, trying to buy it at inflated prices, and exposing yourself to theoretically infinite risk. It is a terrifying place to be. But on the right, we have our strategy. You are covered because that exact asset is already safely secured right there in your backpack. Your obligation is 100% backed by what you physically hold, so no scrambling required. All right, part three, the call explained. Okay, so we know your position is covered, but what exactly is the call in this context? Simply put, it's the binding agreement. It's that firm playground promise you just made. It gives the buyer the right, but entirely at their discretion, it's definitely not an obligation, to buy your item at a set price before the clock runs out on the contract. They are essentially calling the asset away from you. If they change their mind, or say the market drops, they just walk away, and the contract expires completely harmlessly. And what about that set price we keep mentioning? That is your strike price. In our scenario, it's the $50 you originally agreed upon with your friend. If they execute their right to buy, they hand over $50, not a single penny more, not a penny less, totally regardless of what the game is actually trading for on the open market that day. The true beauty here is the sheer predictability of the math. You know exactly what your maximum outcome looks like the absolute second you shake hands. Let's move to and see how this builds in part four, from games to stocks.
All right, let's move this out of the playground and into the actual brokerage account. As investors, we're obviously dealing with equities here, so just map that rare video game directly to owning shares of a company's stock. The fundamental mechanics of risk, reward, and obligation, they are identical. We are simply swapping out the asset class. Instead of a plastic cartridge in a backpack, it's equity in a portfolio. But the flow of the premium and the mechanics of the actual contract remain exactly the same. Now, there is one non-negotiable structural rule in the options market you gotta keep in mind. The magic number is always 100. These standard contracts always operate in bundles of exactly 100 shares. So to safely sell one covered call, you must own 100 shares of the underlying stock to ensure your position is fully collateralized. You can't just write a covered call on 50 shares or even 99 shares. It has to be a clean block of 100, which really just keeps the market standardized and highly liquid. Part 5, steps to success. So how do we actually execute this in the real world? It really boils down to 4 simple actions.
Step 1, secure your 100 shares of a stock you genuinely do not mind holding long term. Step 2, pick a strike price, specifically a price you'd be totally happy selling at if the stock actually gets called away. Step 3, sell that call contract on the open market through your broker. And step 4, which is absolutely the best part, collect your premium. It really is that straightforward to set up once you understand the machinery behind it. Now, what's really interesting about this slide is the psychological win. That premium, whether it's $50 or $500, totally depending on the implied volatility of the market, is real instant cash. It hits your account the literal moment the contract is sold. You don't have to wait around for the contract to expire to get paid. Reinvest it into more shares, buy a coffee, pay a bill. It really doesn't matter. It's yield you've generated from day one, essentially creating your own custom dividend on a stock that might not even pay one.
Part 6. Knowing the risks. Now, of course, there is no free lunch in investing, right? We have to look at the trade-off here. Let's go back to our game for a second to really visualize the risk. What if a wildly famous streamer plays it tonight and demand goes absolutely parabolic? Suddenly, the open market values your game at $100. Everyone wants it. But remember, you already signed a contract with your friend. And a deal is a deal. You are legally bound to sell your 100 shares at that $50 strike price. Even if the stock rockets to the moon, crossing $100, $200, you must honor the contract. Now, listen, you didn't actually lose money. You still made a fantastic, predefined profit based on the exact strike price you picked. But you do experience the severe psychological sting of missing out on those unexpected, explosive gains. That opportunity cost is your primary risk here. So the crucial point is this balance right here. Selling a covered call effectively caps your maximum upside. Yes, you guarantee upfront income, and yes, you lock in a selling price you are entirely comfortable with at the time. But if the stock goes on a legendary run, well, you're not on the rocket ship past your strike price. You are intentionally trading infinite potential for guaranteed immediate yield. It is a very calculated compromise.
Which brings us to the ultimate question for your own portfolio strategy. Are you ready to make your idle assets start working for you? Covered calls are a really powerful, structured way to generate active yield from the investments that are just sitting in your account collecting dust right now. When used responsibly, they literally transform a passive holding into an income engine. Thank you so much for joining me on this explainer. Keep analyzing, stay curious, and I'll catch you on the next one.